Well, hello and welcome to this week's Founding Fathers webinar. I am Craig Yenny, and I'm standing in for Jason Sipple as he's not able to make it this week. Although Jason's not here, we're both excited to be able to share some of this content with you around the infinite banking concept process. And so as I go through this, feel free to reach out in the chat comments, ask questions. Happy to address that as we go through. So Jason and I are both part of the Money Multiplier or the Money School, and Jason runs and operates the Founding Fathers webinar and builds a lot of content around that. But essentially, what we're doing is we're teaching on the infinite banking concept process. If this is the first time with infinite banking, if you can just put in the chat, first time I'm hearing about infinite banking, or if you're a veteran, that's fine too. I'm going to go ahead and share some process around loan operations today. But before we jump into that, the infinite banking concept process was really codified by R. Nelson Nash, who is well known for his book, Becoming Your Own Banker. So although the infinite banking process has been used for generations, we really attribute the kind of bringing it to the mass market, from R. Nelson Nash. So if you haven't read this book, I'd highly recommend it. It's, if you can see here, it's not a very thick book, but it's action-packed, full of content, has a lot of great use cases. It has the mindset, because we've been taught for so long to think and operate a certain way. But one of the key things Nelson Nash would teach is that we finance everything we buy. We're either paying interest to someone else, and we consider that borrowed money. So if we're taking a loan to buy a car or for our houses, or some people, put things on credit cards and kind of carry the balances on those. So we're either paying interest to somebody else through borrowed money, or we're giving up interest by paying cash. So I oftentimes hear people say, well, I just pay cash for my cars, or I just pay cash for everything. Hey, that's great, but you're also, every time, the way I look at it, so I've got this stack of money here. Every time I have $1 or $100, or I've even got a fake $1 million bill here, every time we spend money, that dollar or that $15, that $20, whatever it is, it leaves our family forever. And we oftentimes talk about that in terms of lost opportunity cost, meaning we can no longer earn money with that dollar again. We can never put it to work again. So really, when we think about financing, we need to get out of the methodology of thinking we have no other option. Either we borrow money or we pay cash. There's a third option, and that's really becoming your own banker. When we talk about the infinite banking concept, there are many different use cases, and there's corporations that are using it to finance equipment or buy buildings. Real estate investors using it to run money through to, finance their own rehab projects. But there's really three main use cases. Although it's the infinite banking concept, there's three main ones that we often talk about. If you happen to have debt, so let's say you've got credit cards, car loans, maybe even some medical bills, anything that's considered a debt, you could actually run through the infinite banking concept process, and we help model and show you how that's done through a tool we call the Debt Blaster. So think of it this way. Let's just throw out a number. Say you had $100,000 of third-party debt. The options are you can continue to pay that, and at the end of the debt cycle, all of your money's gone and your debt's gone as well. But what we're teaching is a way where you can recapture a portion of that. So let's say out of that 100,000, if we were able to keep 30 or 40 or 50,000 of that, that's what we're helping people do. So use case number one is debt, paying down debt with this process. We have a lot of people that come to us and say, I don't have debt, but I do have some major purchases coming up in the future. I have a car purchase, or maybe they have children going to college, or like in my case, we have a kitchen project coming up where we're going to do some remodeling. So these are major purchases. It's just not something you have in your regular budget. Is there a way we can the money through the infinite banking concept process to be able to finance that? So that's what we call major purchases. And then the third use case that I wanted to share with you is really about investing. So you might be a real estate investor, or maybe a private lender like a lot of us in this community are, where we take money and we loan it out to a real estate investor who might be doing a rehab to build a rental portfolio. So they're oftentimes short-term loans. Maybe we're getting 12, 15%. Now we can invest right from cash. We could take money out of our savings and put that into the investment. What we're teaching is there another way where we can just add one step to that process, which is put the money into the infinite banking concept process, then lend it out, and now we're making money in multiple places. So what Jason and our team are doing is we're helping to first understand what are your objectives and then be able to model out how that would work for you with your specific debts, your specific major purchases, or your specific investments that you want to make. So with all of that said, what I want to do is kind of talk about one of the key concepts of wealth building, whether it's building wealth through keeping money through debts or financing our own major purchases, or even running money through investments. We want to keep our money moving because money moving continues to grow and add more and more money to the picture. So this is just a quick diagram of an investment strategy. Now, in this diagram, you'll see there's this box over here that says Private Money Club. There's a lot of us in our community. We call it the campfire. So if you've been around our teachings, with Chris Noggle, the money multiplier, we talk about our community as a campfire. It's a little bit more intimate than just a group of people. We get together, we do experiences, we do trips together, we have weekly webinars. But a lot of us do something called Private Money Club, and that's where we lend money from our policies to investors, similar to what I was describing earlier. But for our conversation today, just think of this box, this Private Money Club. You might have a Turo business. You might have some other kind of investment strategy that like and understand. So don't get too caught up on the fact that this is Private Money Club. This could be really anything. This could be your car, your kitchen remodel. But what I want to do is kind of share with you the process of how money moves through the system. Now, one of the first laws of wealth is that you want to be able to save at least 10% of your income. Now, in the United States, there are some pretty interesting graphs out there of the national savings rate over time. And one of the things that we can see from that is during COVID, savings rates went way up. I mean, we're talking people didn't have anywhere to go, they didn't have anywhere to spend their money, so they started saving their money. After people kind of, businesses opened up and things got back to somewhat normal, the savings rate dives. It dives down below 5%. So now as a country, we as Americans are no longer saving what we should. We're somewhere under the 5% mark. But the first law of wealth is save at least 10% of your gross income. So what do you do with that? A lot of people would put that in a savings account, and there's a lot of people that are in high yield accounts. I mean, I have a high yield savings account. Does anyone here on the call have high yield savings accounts? I'm just kind of curious if you do, what kind of rates you're getting right now. I've got an American Express high yield account. I've got a few bucks in there, but Kevin's no. But a lot of people say, hey, this is great. We're getting 4 or 5% in our high yield savings account, but we have to remember that that's temporary. And say 2 years ago, we were lucky to even have 0.1% in some of our savings accounts. So what we're teaching is there a better place to put your savings? And so think of your savings coming out of your income bucket, your job, however you produce income. And we call those premium deposits that we would put into this money multiplier policy, or a BYOB, be your own banker. What this box is, and this is what our team specializes in, is helping you to build out the proper architecture and structure of a whole life policy. And that's the tool that's being used in the infinite banking concept, is a specially designed whole life policy that pays dividends. And we also want to make sure that's with a mutually owned company. So that's where we're storing our money before we go do something else with it. So think of it, you're capitalizing, you're building sources of funds inside of this policy. And whether we're paying down debts or whether we're doing some sort of investment, we're taking loans from that policy and we're putting it into, say, a segregated account. A lot of people get confused thinking that the insurance company or the policy is a bank, and it's not. They're insurance companies. They're not transactional systems. But what you can do is request a loan, and then they'll put it into your linked bank account. Now, once that money's in your bank account, you can do whatever you want with it. And in this model, what we're doing is we're taking those new funds and we're loaning them out on a private money club deal. This could be your churro business to buy a car. This could be to purchase a car for your own family. But we're doing something with those funds. In this case, I'm putting it into a resource that kicks off a monthly interest charge. So I'm loaning somebody money. Maybe they're paying me 12% annualized and they're paying me out monthly. What I'm doing is I'm putting that money back into my segregated account, and I'm scraping a little bit of the gains and I'm paying the loan interest. The rest of that could, if you wanted to, it could all go back into the policy, or it could go back to recycle and go back into compounding inside of the investment. So that's completely up to you how you want to do that. But I just wanted to share with you kind of the motion of the money. So we've got savings going in, we've got loans coming out, we put that money to work. It generates more money, or it prevents us from having to spend money with somebody else, so we recapture. And then we're taking those gains and we're putting them back into the policy. So nothing real complicated here. It's just kind of where the money's moving, and we just keep this for the rest of our lives. And as we're doing that, one of the key concepts is as we're taking those loans, every dollar, so every penny and every dollar that you put into this policy compounds and grows uninterrupted for the rest of your life. So that's one of the benefits, is that we can leverage that money while it continues to grow uninterrupted compound interest. Now, if there's any questions, feel free to throw those in the chat. I don't see anything at this point, but I'll keep moving on unless there are any questions. And of the audience that we have today, is anyone practicing infinite banking now, or are you all just kind of learning about this at this point? Before I move on, I just want to say one thing here. In this operation, one of the things that I'm going to spend the rest of the time today talking about is the motion of taking loans. I get a lot of questions about, how do policy loans work? Do I have to pay them back? How do I get one? Do I have to fill out a bunch of paperwork? Do I have structured payments? So these are a lot of the questions people are asking when taking loans from the policy. And so when you want to get a loan from your policy, your own banking system, it's unlike going to the bank, where at the bank you have to fill out papers, you have to justify what you're doing with the money, you have to qualify. And at the end of the day, inside of the policy, if you have available cash value, the only question is, how much do you want? So there's no paperwork to fill out necessarily for approvals. So you'll basically put the loan request in, and then they'll send the money to your segregated account. Now, with bank financing, if you take a loan, there's going to be a structured payment. They're going to have a certain interest rate and a monthly payment. That's another thing that's different about the infinite banking concept, is when you take loans, they are not structured. You are not required to make any sort of regular payment, any timing of payment. But we do want to be an honest banker, and I'll show you what the benefit of being an honest banker is. But just know that you have complete control of when and how that loan gets paid back. So I often tell people, if they use their policy to buy a car, or you're a business owner and you use some money to finance equipment, maybe you're a construction business and you buy some trucks. If you're working with a bank and you have hard time in your business, or hard time financially, lose jobs, unexpected emergencies are coming up and you have to redirect some cash. Well, the bank's not going to be so lenient on you about your payments, but if you're financing your own equipment through your corporation, or you're financing your own cars through your own system, it's really up to you, and it gives you more control and flexibility. So that's another big part of what we're teaching here, is taking back control of how your money moves and how it operates. So with loans, The way I kind of look at this is I look at the policy as kind of four different buckets. And so the first bucket that I want to address is this premium deposit bucket. So think about this every month, or it could be annually, quarterly, semi-annual. The timing can be any one of those. But let's just say every month we're putting in premium deposits into our own banking system through the infinite banking concept process. You need to remember that every dollar that you put into this premium bucket, regardless of whether you're taking a loan or not, it will continue to compound uninterrupted. So if you want to see the power of this, go out and find on the internet a compound interest calculator and just put in, say, $25,000 for 5 years, for 10 years, for 20 years, for 30 years. And you start to see the power of uninterrupted compounding. Now, most people say, well, I'm going to put my money in my savings account. I'm going to let it build up there, and then I'm going to take it out and go buy something. That's when we start basically stopping that compounding or that interest accumulation that we were getting because we took the money out. And it's not that way in the infinite banking. The second bucket is what we call the cash value. And when you look at a policy or an illustration, it'll have your premium deposit, your cash value. Think of the cash value as kind of a number that's going to be going up and down throughout the life of the policy. It's not reflective at all of how much is in your system compounding, because that every dollar is in the premium bucket compounding. This is a reflection of how much the insurance company is allowing you through an advance of death benefit to be able to use while you're alive. And so if, let's just say, for example, you had $10,000 available cash value and you took out a $5,000 loan, your available cash value is going to go to 5,000, just like a gas gauge. So if we drive our cars and it's not an electric, let's say we have a gas-powered vehicle, when we drive it, our gas gauge is going to go down. Just like when we take a loan, our available cash value is going to go down. When we go to the gas station and we fill it up, the needle goes back towards full. When we pay a loan back, our needle goes back to full. So just think about the cash value bucket's going to go up and down throughout the life of the policy as you're using it and paying things back. The third bucket is the death benefit. And this is essentially the collateral, if you think about it, when you do a loan from the insurance company. The reason they're so flexible and they don't have structured payments is they know that they've got collateral in your death benefit. So if you've got say a $500,000 death benefit and you're using $10,000 of cash value, well, they're not too concerned about that because they know at some point you will graduate or pass away. As we call it graduate, but you'll pass away at some point. And if you have outstanding loans, they will just simply deduct that from the death benefit and pay that out to your beneficiary. So that's why they don't care too much about the structure of the loan and when and how you're paying it back. The last bucket is the life insurance's general fund. So the insurance companies have big piles of cash. And when you take a loan, it's coming from that bucket. It's not coming from your premium. It's not coming from your cash value. That's just an indicator. It's coming from the general fund of the life insurance company. And there's a charge that comes along for the ride. And that's what we're going to spend the rest of our time talking about, is how does that interest work? Because I get a lot of people saying, you know what, Craig, I don't know. I mean, why would I pay 5% to use my own money? And that's the argument that I oftentimes hear. What they're not really understanding is that you're compounding, your money is growing, and you have a loan interest, but there's a positive arbitrage, meaning you're growing more than the cost of the loan will ever be, depending on how you run the policy. But one of the examples that we oftentimes talk about, and you may have heard this if you've been following our team for a while, and I'm just going to ask this question, and then you can go ahead and put your answers in the chat. Do you think I would be an honest banker in this situation? Let's say Terry, Kevin, Shauna, say one of you go into your bank and you might have had $25,000 in your savings account, and you walk in the bank and you said, hey, Mr. Banker, I'd like to take my $25,000 out of the bank because I'm going to go buy a car. And let's just say that that banker at that time was paying you 4% interest. So you're compounding at 4%. And the banker says, wait a minute, why don't you leave your money in your bank at 4% and I'll give you a loan at 6%? It'll be way better for you. Now, let me ask of the audience, do you think the banker is being honest? Should I keep my $25,000 in my account growing at 4% and take his 6% loan? Is that beneficial for me? So I'm just kind of curious. Kevin says, no way, not going to do it. And that's the common answer, Kevin. So I appreciate you reaching, putting the response back. Terry's like, not in a bank. So here's the math behind the situation. If I compound $25,000 at 4% for 5 years, that's going to grow to 30,525, I believe it is. And Drew, hey Drew, welcome to see you. Glad you're out here. If my math is wrong, just let me know. But I think 25,000, 4% compounded for 5 years is about $30,525. Now, in the same time, if I took a loan at $25,000 at 6%, I'm going to end up paying just about $29,000 over the course of the loan. So here we are, we're growing at 4% and we made $30,525 and we paid a loan at $29,000. So am I not about $1,500 ahead? So wasn't the banker telling me the truth that I could grow at 4% and pay a 6% loan and still make money? And if you want to kind of run with those numbers, just get a compound interest calculator and get a loan calculator and go run the numbers and you'll see what I'm talking about. But that's one of the fundamentals behind infinite banking is that we can compound on a growing number and pay a loan on a shrinking number and make money all day long at 4 and 6%. Now, with all of that said, I want to get into some of the loan operations, and this might get into a lot of numbers. I'm oftentimes using spreadsheets and different numbers just to kind of prove concepts out and figure things out. But here's what I want to share with you today is here is a loan calculator for a loan specifically for life insurance. Now, when you look at loans, there's different loans like our mortgages, and there's HELOCs and car loans and credit card loans, all these different things. And not all loans are treated the same. So in this case, we're dealing with a simple interest loan. And what that means is we don't have an amortized schedule of interest and principal. So when you have a simple interest loan, let's just say year one, month one, let's say we start in May of 24, we take out a $10,000 loan from our insurance policy. Now, let's just say at this case, and a lot of the policy loan rates right now are 4.8 to 5%, somewhere in that ballpark. So let's just call it 5%. If I have a 5% loan rate, what I want to share with you is that could be 5% or it could be something less. But essentially the way this calculator looks at the numbers and says, okay, here's your loan of 10,000. In month one, you had a balance of 10,000. So we do a monthly interest charge on that, which is $42. So for the first month of using this money, there's $42 of interest accrued. Next month, we have the same principal. You'll notice that the interest did not get put onto the loan balance. They keep that aside. So now this 10,000 going into month two, we now have a cumulative interest charge of $83. And it just continues on through the year or through the months of the year. And you'll also notice I didn't pay anything back. So I paid nothing back towards the loan. So guess what? My total interest accumulated is $500 on my 10,000. Well, that's 5%. So sure enough, if the interest rate is 5% and I don't pay anything back, there's a 5% interest charge. Now, there's a couple things that can happen from here. If I'm at my policy anniversary and I have $500 of loan interest, what if I don't want to pay that? Remember, I said earlier on, there's no structure to how these loans get paid back. There's no rules and regulations from the insurance company that you have to pay your loan interest. So what'll happen is if you don't pay this, they'll put that onto the principal, and then in year two, so month one of year two, your loan balance will be $10,500, and it just keeps going. So that's step one. We didn't pay anything back. It's 5%. That makes sense? All right. So now what we're going to do is we're going to look at Month one, I take a loan of $10,000. And now what I'm going to do is I'm going to make a payment. So maybe I bought a car, or maybe I went out and bought, something for my business, whatever it might be. I'm now going to pay my system back $500 every month for the rest of the year. So in the first month, when I put that $500 in, you'll see that my loan balance is now $9,500. So when you pay your mortgage, just take a look at how much of your payment goes towards principal. And it might be 30%. If it's a brand new loan, even within the first 7 years, you're typically going to be paying probably somewhere in a ballpark of 70 to 80% of that payment is going to be interest, and the rest of it's going to principal. The simple interest loan is very powerful because all of that 500 went to buy down my principal. Well, what's the benefit of that? It buys down my interest over time. And so I can kind of illustrate that. This little red box that I just popped in here, this is the interest charge from the previous model where I didn't pay anything back. So you might look at this and go, okay, if my loan balance was $10,000, my interest charge was $42. Whoopee, it's now 40. But it's not the $2 I'm concerned about. It's the process of buying down the interest. So you'll see as we go through the year, the next 500, I have $83 accumulated in of not paying, and now it's 77. So here's really how the math works out. If we just shoot all the way down to the bottom, the 12th month, if we didn't pay anything, we had that 500, but now since we did pay back, we have 338 of interest charge. So just doing some quick math, and you can see it over on the far right. Now our actual loan cost is 3.3%, not 5%. So even though the insurance company is saying we're charging you 5%, we didn't pay 5%, we paid 3.3%. And there's one other thing going on. We're still compounding. So our compounding and the APR of the interest charge, we still made money. We made money using our money to buy a car, to go finance a major purchase. The other thing that's happening while we're doing this is every time we put that $500 back into the system, remember I talked about the cash value bucket has the gas gauge on it? Every time we put $500 back into the loan payment, it goes back in to refill our cash value bucket, our available cash value bucket, by 500. So by the end of the year, I have $6,000 more dollars put back into my cash value that I can pull out and use again. So let's say at month 8, something comes up and I need a couple $1,000s for an emergency. Well, guess what? I put 4,000 back in. I can pull it right back out. So that's one of the benefits of being able to pay back your loans. So who would agree? And Drew, I'm sure you've been checking the math, but here we are at a 3.3% interest rate. Any questions on that so far? The math definitely math, says Drew. Thank you. So now here's another example. I'm not going to go through it in great detail, but I'm just simply showing the more that I put back into the loan payment. So I'm putting in $833. What I'm going to do is buy down the principal even more. And so now my interest accrued is $229, which means my effective interest rate that I paid on the use of this money is 2.29%. And so, Kevin, I see that you have a note on there, but if you have a specific question, you can put it in. I can see if I can help address it over during this session. But, really what we're just trying to show, without getting into a lot of the details of the math, is by being an honest banker and putting money back into the system, you're actually recapturing that money to use again, and your interest charge is much less than what was stated, say if it was 5% or 6%. I mean, it's just going to be cheaper. The last thing I really want to go through is just to talk a bit about what I mean when I say honest banker. So let's just say, for example, and you can pull up any calculator on the internet you want just to do a loan, but I just build my own with my spreadsheets. Let's say we're taking a $25,000 loan and we're going to finance something at 6% for 5 years or 60 months. That means our payment is going to be $483.32. Okay, So if I'm buying a car or I went to the bank to finance something, maybe I'm buying solar panels for my house, whatever it might be, I now have a loan structured for 25,000, 6%, which is going to mean I'm going to pay $483.32 for the next 5 years, every month, $483.32. And so the whole purpose of this exercise is just to get what this payment number is. That's what I'm looking for. So when I'm doing infinite banking, if I'm going to go buy a car or I'm going to finance some major purchase, this is what I'll do is I'll just go and say, okay, if the bank's going to charge me 6% or maybe it's 7%, what's that payment? That's what I'm looking for. Because this is what I'm going to put back in to my own system when I borrow money from my own system. This is what I'm going to pay back. All right. So let's just take a look at something. So if I'm doing third-party financing, I go to my local bank and they're going to give me $25,000 and charge me 6%. However, in my policy, let's say I've got a life insurance policy with my infinite banking concept process, it's going to charge me 5%. So to be an honest banker, what we're going to do is we're going to pay $483.82 for 60 months. So we're going to continue paying that, but guess what's going to happen? What do you think will happen if I continue to pay $483.82 for 60 months back to the life insurance company who's only charging me 5%? Who can tell me what's going to happen? Am I going to perhaps pay this loan back and still have payments to make? Because that's what's going to happen. So I'm going to overpay the loan back to the insurance company, but where does this excess money go? And this is a question I get a lot is, well, wait a minute, Craig, you're telling me that I'm going to pay my life insurance company loan back and still have money. What do I do with this money? Where does it go? So what I want to do is just kind of talk about that. So what we're going to do is we're going to show, this is year 5. So you see over here, I've got number 5. I didn't show you year 1, 2, 3, and 4 because it would pretty much be the same thing of making $483.32 payments. But at year 5, we're going to continue, our payments, and we're going to get to month 9 and we'll have $448 of balance remaining. So because I was paying a 6% loan structure back to a simple interest 5% loan structure, I paid it off earlier than 60 months. I paid it off in 57 months. So what I'm going to do is take on that last month, I'm going to take that $448, and it's going to come out as 483. So I'm going to have what, 30 some dollars this month left over that I need to do something with. And so in month 11 and 12, I have a full 483 and 32 cents. So that totals 1,001 and 15 cents. And what we're going to do with that is that's extra money. And if you were financing with a say a bank or a car financing company, whoever it is, we would have made these payments regardless. So in order to be an honest banker, we're going to keep that money in our system. So option number 1, and the most favorable thing you could do, is you would want to put that in on the premium side of the policy. Now, a lot of people will say, well, Craig, I don't have any more room in my premium. I've maxed this thing out for the year and I cannot put a dollar in. So when our team designs policies, we're typically designing them to allow you to put in up to the maximum. So if you're going to put in 1,000 a month, or if you're putting in, 15,000 a year, or whatever that number is for you, we're going to design those policies so you can max fund it with the amount of money that you have. So there's typically not a lot of room in there. However, if you didn't get the full funding in for the year, maybe you had some rough months, or maybe you had some other expenses that just didn't work out for you, no problem. We can now take this $1,000 that we have and we can put it into the premium. And the reason that's the beneficial way to do it is, think about that $1,000 that you put into the premium side. That's going to be added to that premium bucket, that first bucket I talked about, and it's going to compound and grow for the rest of your life. You might say, I don't have room in my premium bucket. My premium bucket is full for the year and I have to wait until next year, or, or maybe even next month, whatever it's going to be for you. We can take this $1,000 and put it into a segregated account and just keep it there, and it can be used for premium for next year. So there's the thing is, it's still in your system. It's just that we're going to get it into the policy when we can. Now, if you get to the point where you continually have more and more money that you can't get into your system, then what we'll do is have a discussion about starting another policy, perhaps. And that's why, and I think some of you, I recognize some of your names on there and on the list that's joined us today. And I know some of you have multiple policies. I have multiple policies. And the reason we have multiple policies is either to build capacity for the future, because at the end of the day, as we get older, as time goes on, we're not guaranteed of anything in terms of our health, or maybe some sort of accident happens and we may not get insured. So some of us will get policies to create some capacity and get the policy while we're able to, because 5 years from now, I don't know, maybe I'll have some big health issue and I can't get any more policies. So that's one reason you might have multiple policies. But the other reason is we've got more money coming through our system than we can get into the policy. So maybe it's due to investing or you recaptured. And as I shared early on, the whole debt pay down, once you pay your debts off and you've recaptured a lot of that cash value, well, you not only have the cash value in your policy, but you also have all those debt payments. Let's say you're paying $1,500 a month to debts. What are you going to do with this $1,500? Sometimes we start new policies. So anyway, with all that said, hopefully this gives you a better understanding of how the loans work inside of the infinite banking concept process and the policies. And it hopefully covers a lot of the questions that you had. These are the ones that are probably the most common from the folks that I work with. They just don't understand, how does this work? How do I pay my loans back? What if I don't pay my loan back? What if I overpay it? Where does the money go? So those would be the most common questions I hear. If you have others, I'll hang on for just a few more minutes, but this is really all I have for you today. If you do have some questions, go ahead and put them in the chat. I'm happy to address them. So I'll wait just a few moments to see if anyone has questions, but if not, we'll go ahead and wrap it up for the day. And one request I would ask before we all depart, if you can go to Jason Sipple's YouTube channel and make sure that you subscribe if you have not already subscribed. And if you click on the little notification bell, you'll be notified anytime Jason goes live. You'll be notified when he provides new content. So every week he's putting new information out. So if you haven't already done that, please go subscribe. And I appreciate your time today. And if there's any questions, you can always feel free to reach out to Jason. You can also reach out to me. I'm Craig@chrisnoggle.com is my email. I'm happy to answer any questions. If, say 2 days from now, you think, gosh, what was Craig talking about? Feel free to reach out either to Jason or myself, and we'll get your answers back to you. So with that said, I hope you all have a great rest of your day and a blessed day, and we'll see you on the next show.